Hey, how's it going, beautiful people? Merry Christmas and welcome back to the Dividend Compounders Show. In today's video, we're going to be going over stock recommendations that are $20 or less. And how is the video going to unfold? Well, we're going to go over each company and give a brief overview of why they are where they are, from risky to least risky. And in total, there's going to be 7 companies discussed in this video. Now, for some of these companies, I already made a deep dive video that will make you feel like you understand the business beyond belief if you want to go watch those. And for some of the other companies, I have not made a video. If I tried to squeeze my thorough analysis for each one of these companies, this video that you're watching would have been like 3 or 4 hours long. And we all know that your wife's boyfriend made plans for dinner and you can't commit to 3 hours to watch this video. But jokes aside, if you want me to go deep into one of these companies and to make a dedicated video for it, let me know and I can make that happen. First on this list is going to be Intel. Intel is an all or nothing bet. And what I mean by that is it's either going to make your wife hand you divorce papers or you're going to be able to afford the hair transplant that you've been eyeballing for years. Shout out to today's video sponsor, which is Turkey, for the cheap medical tourism prices that they offer for balding men like you and me. Alright, you got me. I was just kidding. But really, when I think about Intel, it's a gamble. In my deep dive video that I made for them, I go over the bull case and we go over the argument against Intel. Anyways, even though I consider Intel to be risky, Intel is a revenue-generating machine, despite shooting themselves in the foot again and again. And just in case you don't know, Intel is one of the biggest players in the semiconductor chips space, in particular for PC CPUs, and they're trying to make a pivot into the data center AI space. Now, as of currently, Intel does not have a current PE ratio, and that's because their earnings per share is negative $3.76. However, when we turn our eyes to the trading multiple that is the forward PE in the future next year, then it's a 28.9. They currently trade for about $20 a share. Depending on when you watch this video, sometimes they can get as low as about like $18.51, and depending on how the markets feel on a particular day, they can go as high as like $22 a share, sometimes like $23. Roughly, we're going to go ahead and say that Intel is a stock that trades for under $20. They currently do not pay a dividend because they are facing a pivotal point in their company history where it's going to be an all or nothing endeavor into the foundry manufacturing side of the business. Now, when we take a look at their financials, the only one that we're going to be considering is the free cash flow, so that this video is not going to be 5 hours long. And as we scroll down and we look at it, Intel's current free cash flow is negative $15 billion for the past 12 trailing months. The year prior, negative $14 billion. The year prior to that, fiscal year 2022, negative $9.6 billion. You want to look at it visually? Yes, it is not looking good. Intel is burning through cash, and they have to because they are spending all the capital that they have right now, all hands on deck, into making this foundry thing happen. Consequently, that's also why the dividend had to disappear. But at about $19 or $20 a share, it's not exactly the worst idea in the world, especially if you think about the optimistic outcome. If they pull it off and they can get this foundry up and running, and everyone, including Microsoft, Amazon, and Google, take all of their contracts from TSM to Intel, if that actually happens, Intel could be one of the most underrated and undervalued companies on the stock market right now. However, is that going to happen? I guess only time can tell. Number 2 on this list is going to be AES Corporation, ticker symbol AES. They own and operate power plants located all around the world, including South America. So this company, when we think about AES, they generate electricity and then sell it to businesses in the form of PPAs, aka power purchase agreements. They also have a utility business for residential folks in Ohio and Indiana. However, their bread and butter is supplying companies that have a huge need for electricity. Their growth driver, according to their earnings report, is partnering with the biggest tech giants and their data centers. They mention data center again and again because they realize that that's where the money is going to be in the next 5 to 30 years. And tech giants partner with AES because the green movement is all the rage across corporate America right now. To be net zero emissions is to have the biggest pair of nipples. In the context of nipples, it's a good thing. If you're new around here, I always make a reference to nipples, especially if they're sweaty. And it's not always the case, but if the local utility operates off of coal or gas power, then that doesn't work with being green, especially if you're Google or Microsoft. That's where AES comes into the picture. Also, sometimes the local utilities can't supply enough power to meet the demands of the data centers, even if they are running and operating off clean energy. That's why some businesses choose to buy a bulk of electricity power up front to make sure that their data centers or factories or anything that's very sensitive can operate without interruption. For instance, right now, Texas is becoming home to the next manufacturing boom for semiconductor chips. And if you're operating a data center or a semiconductor fab factory there, then you're most likely going to have to buy power from AES in case the Texas utility grid fails like it has in the past. So when we think about AES Corporation, it's not exactly the sexiest business model, but power and electricity is a very stable and reliable industry. The only drawback is the massive amount of CapEx, capital expenditures, and how much cash they have to spend on building out the solar panels and other renewable projects. If it weren't for that, I would be more interested in the utility sector as a whole. But that's the reality as it stands. It's an industry and a sector where you have to spend a ton of money to build new infrastructure, but also to continuously upgrade it and maintain it. So they do have to take out loans, and it's just a part of the industry. And at the time of making this video, AES is currently trading for about $13 a share. Year to date, they are down by negative 32%. It's pretty wild, right? When we look at their 52-week range, the lowest price was $12.24 a share, and I think they hit that back on December the 18th, so just a week ago. When we look at their current trading multiple, it's a 9. Yes, a single digit of 9. And their forward PE ratio is a 6.2. And when we take a look at the price target given by Wall Street analysts, they believe that AES is worth about $20 a share, which as of right now at $13, that's an upside of 60%. Yes, friends and family, 60%. For AES to be trading at a 6 trading multiple for the forward PE, I wonder if their financials are going to be really ugly and terrible. As a matter of fact, let's do that. So right now we're looking at their income statement. The line item that I care about is the revenue, which is what investors refer to as the top line. In fiscal year 2019, it was about $10 billion. You fast forward throughout the years, now we're looking at $12.2 billion. So overall, in a bird's eye view, it is going up and going in the right direction. To back it up a bit, their market cap is $9.2 billion. Their revenue is $12.2 billion. Please make it make sense for me. I understand that they're in the utility business and it's very mature and their prospects of growth are very low, but still, this is wild. They're $3 billion above their market cap. However, when we look at their cash flow statement and we scroll down to the free cash flow, it makes sense. Right now, this company is burning through cash like no other. They are negative $5.7 billion of negative free cash flow. That's pretty bad because if you just back up to fiscal year 2020, they were positive at $855 million of free cash flow. But to go from that to a negative picture that is getting worse year after year, it does raise some red flags. So that leads me naturally to my next question. Their dividend right now is 5.3%. Is that dividend going to be sustainable since their free cash flow is an ugly mess? And the dividend payout ratio is 29%, which means that the dividend is sustainable and it's healthy. They can keep paying this dividend and there's going to be no fears of it being cut. If this payout ratio was somewhere around like 70 or 80%, which is usually the average for a utility company, then we'd be like, okay, it's a little high, but nothing too crazy. And then if it was in the ballpark of like 95% payout ratio, then that red flag would be up. That dividend is not going to last. But when it's less than 30% for a utility company, that's good. So even though the free cash flow might be negative because they're expanding upon their renewable energy projects all across the globe, at least the dividend is safe for now. Every quarter or 3 months, you got paid 14 cents in dividends. And it's awesome to see how the dividend has been growing year over year. And then as of this upcoming year, it's going to be 17 cents every 3 months. Not bad. Number 3 is Smith & Wesson. They're in the pew-pew business. I'm not sure if I can say it or not. I don't want to risk it. And love it or hate it, Americans value their Second Amendment. So all I'm trying to say is if there's ever a huge invasion on American soil, it's not the US military the enemies should worry about. I'm telling you, it's going to be the mountain folk that reside in West Virginia. It's the cowboys in Nevada. It's the hunters in Wyoming and South Dakota. And the list goes on and on. The love of weapons in this country go very deep. Now, as you can see, I made a 30-minute deep dive video on Smith & Wesson. I go over all of the basics, the investing thesis, and the drawbacks for this company. So if you want more information, watch that video. But if you're too lazy to watch it, then I got you. I would argue that Smith & Wesson have an interesting business model that is very polarizing. And as I alluded to earlier, you either love it or you hate it. And if you have never shot a rifle before, you should look into whether or not there's a shooting range near you, because I'm telling you, it is an absolute blast, quite literally, in a fun way to spend a weekend, especially if the instructors are nice and they have really large pepperoni nipples. So as it stands right now, Smith & Wesson trade for about $9.85. I'm assuming when you watch this video, they're probably going to be closer to around $10 a share. Their current trading multiple is a 12.5. Their forward PE ratio is a 21.8. The price target that the analysts on Wall Street have for Smith & Wesson is about $13, an upside of 32% to their current trading price. When we look at their stock performance for the past 52 weeks, year to date, they are down by negative 27%. The 52-week range is $9.84 all the way up to $18.05, which I think was back in March. So right now, they are hovering around their 52-week low, meaning this stock historically is at its cheapest price. So what I am saying is in fiscal year 2020, they posted about $529 million of revenue. And as we fast forward throughout the years, for the past 12 trailing months, their revenue is $514 million. So what I think is happening, Smith & Wesson have reached a point in their business where things are just very flat and it's not growing. Because when we look at fiscal year 2021 during the pandemic, they made $1 billion of revenue. But since then, it's just been declining and now they're just flat. They're exactly where they were back in 2020. So unless more people are inclined to buy pew-pew tools, this revenue, I have no reason to believe that it's going to grow. However, even if it stays flat at $500 million, as long as the company focuses on their balance sheet, reducing their debt, increasing their margins, and increasing their cash flow, they'll still be okay. Obviously, in a perfect world, you want to see the company increasing and growing their top line year over year. But if that's not possible, the next best thing is for them to be working on optimizing all their margins and metrics. And then when we look at their cash flow statement, I'm going to be specifically looking for the free cash flow. It's negative $1 million. So the revenue is flat and the free cash flow is negative. So I think maybe you can see my logic in why Smith & Wesson is number 3 on this list, because when it comes to Intel, they're negative billions of dollars in free cash flow, and then for AES, they're also negative $1 billion. And then when it comes to Smith & Wesson, we've got negative $1 million. But something that I do want to call out is that they are an ultra small cap. Smith & Wesson's valuation is roughly $433 million, which is super tiny of a company. And when we take a look at Smith & Wesson's dividend profile, they currently have a 3.6% dividend yield, which I would say is pretty decent at that average range of about 3.5%. That's when things start to get a little juicy. The payout ratio is 65%, meaning the dividend is sustainable and they've been growing it since 2020 and went from about 8 cents every quarter to now at around 13 cents every quarter. So the dividend profile at least makes up for things on their balance sheet and their negative free cash flow. And number 4 on this list is going to be ADT. ADT is the biggest player in the home and business security market. Their products help you to detect and call the authorities if someone breaks into your establishment. Although I would argue their systems don't work when Santa jumps down and drops a number 2 in your living room toilet. But jokes aside, ADT operates on a subscription-based revenue model, which as we all know is that toll booth money-generating way to do things, and that's why the market is shifting from one-time payments to subscription-based models, and they also implement AI into their monitoring system. So it is a company that is evolving with the times and has a premium brand monopoly against the competition, such as Amazon's Ring. And obviously there are other companies out there that do what ADT does. I think when it comes to home security systems, ADT's customer service and support is without a doubt probably the best out of the whole bunch. So as of right now, on December the 23rd, ADT trades for about $6.80 a share. Year to date, they are down by negative 0.29%. So they're red for the year, barely. So if you bought into ADT last year in your portfolio, it would probably be flat as of right now. The current trading multiple is a 6.9. Their forward PE ratio is an 8.7. And the price target for this company is $8.55, which is an upside of 25%. And when we take a look at their financials and we look at their income statement, their revenue went from $5.1 billion in fiscal year 2019 to this past trailing 12 months, $5.1 billion. As you can see, ADT is relatively flat and is in a very mature industry. So they're going to have to grow outside of the box or make sure that their balance sheet is bulletproof. Or as JP Morgan Chase CEO Jamie Dimon says, a fortress balance sheet. So the top line is flat, and if we look at their cash flow statement to assess their free cash flow, hopefully that's a better situation. And finally, the first company on this list of stocks that are under $20 to post positive free cash flow. For the trailing 12 months, they posted $1.1 billion of free cash flow. This is awesome. This is exactly what you want to see, especially when it comes to the free cash flow, because that tells us the company is generating a ton of cash, is profitable, and is doing well. Even though the revenue might be flat, at least the company is generating good cash on their operations. You'll love to see it. So you can see why ADT is placed on the list where they are. And when we take a look at their dividend profile, their current dividend yield is 3.2%, meaning for every share of ADT that you own, you get paid 22 cents in dividends per year. I know it sounds small at first, but if you break it down like this, every $100 invested into ADT, then you get paid $3.24 of dividends. A different way to look at things. And the dividend payout ratio is 22%, meaning the dividend is absolutely sustainable, it's very healthy, and there's a lot more room for growth. And speaking of growth, they grew this number by 57% year over year. And one of the best attributes of ADT is that they have a solid capital allocation plan. They use their money to grow the business, to reduce their debt, and to pay out the dividends, and of course, to grow it. And they also do share buybacks. And of course, as we just learned, this company generates cash. The free cash flow picture, amazing. And at this point in the video is the honorable mention. It's going to be SiriusXM, ticker symbol SIRI. When I researched this company, I spent 3 days, 72 hours, reading and listening to everything that I could about Sirius, the company, to figure out why Warren Buffett bought into this stock. As a matter of fact, Warren Buffett owns a third of all shares outstanding of SiriusXM, which probably means that he wants to acquire it into the Berkshire Hathaway portfolio, or that he's absolutely bullish about Sirius Radio. And I'm not trying to say that he's always right, but he is one of the best value investors that have ever lived. And after doing my homework on SiriusXM, I think I understand where Warren Buffett is coming from, because SiriusXM has a very interesting investing thesis. They have a monopoly when it comes to satellites for the purpose of radio. And surprisingly, they have really solid fundamentals. So they're currently trading for about $23 a share. Year to date, it is down by negative 57%. That's pretty bad. Their trading multiple is not available because of a negative earnings per share due to their departure with Liberty Media. However, their forward PE ratio is an 8.4. The price target from Wall Street is $27 a share. When we look at their 52-week range, it went from $56 as their high back in January, and they reached their lowest price ever on December the 19th when it dropped down to $20.47 a share. I'm not going to lie to you, I was eyeballing it and I was thinking about jumping in, but then I was like, what if it goes to $19.55? So for me, I was thinking about jumping in once it touched the $19 to $18. However, once it hit that $20 mark, it has rebounded. The past 5 days, it is up by 2.7%. And because SiriusXM trades above $20, that's why they ended up being an honorable mention. Because when we take a look at their financials and income statement, look at their revenue. Fiscal year 2019, it went from $7.6 billion to $8.6 billion for the past 12 trailing months. Their market cap is 7.8. Their revenue is $8.6 billion. Do keep that in mind. And when we look at their cash flow statement, their free cash flow right now is $919 million for the past 12 months, which sadly is a decrease from their high of about $1.6 billion back in 2019 and 2020. So their free cash flow has seen better days. But with that said, the company leadership is expecting the free cash flow to improve and to grow in about a year or so. And when we take a look at their dividend profile, right now, SiriusXM has a dividend yield of 4.6%. That's pretty juicy. Meaning for each share of SiriusXM that you own at $23, the annual dividend payout is $1.08. And the crazy part is, take a look at their dividend payout ratio, a 3.1%. Yes, a 3.1%. That's basically Apple or Google or Microsoft's dividend payout ratio, meaning they have enough cash on hand to keep growing and sustaining this dividend for the time being. And SiriusXM grows the dividend by 7.6% year over year. Now, the next two companies on this list are both going to be regional banks, but they do differ in their business model. And you might find yourself asking the question, why am I suggesting smaller banks instead of the big dogs like Bank of America or Wells Fargo? Well, first of all, both of those are above $20. And number two, both of these banks that we're going to talk about have fantastic fundamentals and numbers. Not to mention, with the upcoming presidential administration coming in January, and with the whole Doge operation, I think deregulation is going to be really, really good for the financial sector and banks as a whole. So does it really matter if the bank is regional or worldwide? I mean, take a look at some headlines that you see on your screen right now. But I understand your concern because at one point during the pandemic, we all thought that online banks like SoFi and Chime were going to eliminate all the small players. However, the exact opposite happened. The smaller banks have transitioned into the digital age, which means they offer a mobile app, but they also offer a physical branch where you can go in, talk to a real human, and deposit cash or for other services. And not only that, these regional banks have a lot more capital and customers already established. That fact alone allows them to compound and grow faster and harder than these online banks. What people often forget is that a business that prioritizes and focuses on relationships will be successful in the long run. Local credit unions are pretty solid too. I do have to give that shout out in case some wise guy comments on how evil banks are and you should stick to the credit unions. We hear you. Please sit back down and drink water. Thank you. The first of the two regional banks will be Key Bank, also known as Key Core. And unlike the other regional bank that we're going to talk about, Key Bank focuses more on lending loans to commercial companies and investment banking. And if you didn't know, that's ultimately how banks make money. They lend money out and they make profit off the interest. Well, 70% of their revenue is based off of commercial banking, and consumer banking makes up the other 30%. So you can see the company company prioritizes the big money rather than the smaller residential people. And according to depositaccounts.com, which is a website that reviews and grades banks based on their financial health, they give Key Bank an overall A rating. Because when it comes to banks, you can't exactly evaluate them the same way you would with, say, Google or Microsoft. A financial institution is a whole different beast. All that to say, to have an A health grade by depositaccounts.com is pretty spectacular, because USAA, on the other hand, holds a B health, just to put it into perspective. Now, unfortunately for Key Bank, their trading multiple and PE is all sorts of jacked up because of a recent portfolio repositioning. In other words, what that means is they adjusted how much money they invested into bonds, treasury notes, and other fixed income instruments. So as a result, their numbers are all wonky right now. However, I did the manual math and calculations, so their forward PE is 11.9, and their current dividend payout ratio is a 52%. With that said, let's go ahead and look at their profile. Key Bank currently trades for about $17.22 a share. Year to date, they are up by 19.5%. Anyways, their market cap is $17 billion, and if you look at their current trading multiple, it is 6,900. As I said, that's why we did the manual math, to show you that it's not as crazy as it looks on paper. And the price target for this company is $19.21. When we take a look at their 52-week range, they did reach it at one point. They were trading for roughly $20 a share back in, back in November, but since then, they started dropping deeply after the election. And when it comes to banks, we don't look at the free cash flow to evaluate the profitability and their cash situation, because the free cash flow includes the net change in operating assets. Remember, for a bank, they make profit from their loans and the interest that they get paid. So when a bank expands its balance sheet by increasing the number of loans that it has, this appears as negative free cash flow, and it's just not true. So in the case of Key Bank, what we're going to look at instead is the net interest income. And from fiscal year 2019, they posted $3.9 billion. You fast forward to today, and now it's $3.6 billion. It has gone down from their high of about $4.5 billion. And just for fun, if I show you their free cash flow situation, you'll see why it doesn't make sense. So their free cash flow is negative $111 million. That's just not how it works when it comes to banks. That's not what you should be looking at. Likewise, when it comes to REITs, you should be looking at the AFFO, the adjusted funds from operations, instead of the free cash flow. But when we take a look at their dividend profile, their dividend yield is currently 4.7%, meaning for every share of Key Bank that you own, you get paid 82 cents a year in dividends, and the payout ratio is realistically 52% based on next year's estimated EPS. And something that I do want to call out is they have not grown this dividend since August 29th of 2022, and went from 19 cents every 3 months to 20 cents every quarter, and Key Bank has just consistently paid 20 cents every quarter since then. So their dividend profile makes sense, but I wouldn't necessarily label it as juicy. At 4.7% dividend yield, it's good, but to know that it's not growing year over year, it does deduct from the fact that it is a 4.7% dividend yield. And then the company that is in first place out of all the stocks on this list is going to be Huntington Bank shares. This is a regional bank that is pretty popular in the Midwest. On the left side of your screen, you'll see all the different locations that they service, where if you think about it, one family in the Midwest is going to bank with them and then enroll their children with Huntington. And then the cycle continues with the next generation. So in the Midwest, I would say they have a pretty decent footprint. In terms of assets, Huntington and Key Bank are pretty similar at about $190 billion each. However, Huntington has an A+ Texas ratio and deposits $162 billion in just 3 months. So between Key Bank and Huntington, I would argue that Huntington wins by the tiniest of margins, because their numbers and finances that we're going to be looking at here in a little bit, they look a little healthier, but also their business model revolves around the consumers and small businesses in lieu of commercial clients like Key Bank. And believe it or not, but consumer-focused loans tend to be more resilient than commercial-focused loans, especially during bad economic times. As such, I think they are running a pretty good banking operation in my opinion. Let's take a look at it. Huntington is currently trading for about $16 a share. Year to date, they are up by 28% or just shy of. Their 52-week range is $12 a share at their lowest, and at their highest, they were at $18.45. Their current trading multiple is a 15.8. Their forward trading multiple is a 12.5. And their price target is $17.36, which they did hit effectively back in November, right before the election. Since then, they've just been going on a landslide. And that's because the banking industry as a whole is affected by the rate cuts. And now when we look at Huntington's financials and we take a look at their net interest income, in 2019 they posted $3.2 billion. And ever since then, it's just been going up in the right trend in a positive, growing direction. But for the past 12 trailing months, they posted $5.2 billion, which is a decrease of negative 5% from the year prior. But all in all, I would say their net interest income looks pretty healthy and it looks pretty good. They pay a 3.8% dividend yield, which means for every share of Huntington that you own, you get paid 62 cents a year in dividends. And the payout ratio is slightly high, but it makes sense because they are operating in a very mature industry, the financial institutions and banks, 60%. So all things considered, it's weird to think about a regional bank being one of the best dividend paying under $20 stocks out there right now. However, their financials and numbers look clean, as we just saw. And of course, we didn't do a deep dive and go through every metric and evaluation, because then it would have been like a 4-hour video. But off of surface value, we can say that Huntington looks pretty solid. However, because they are geographically based in the Midwest and they only operate there, their growth upside is limited. I'm not sure if they have a game plan to expand outside of that area, but something else to consider is that their dividend doesn't grow on time every year like Realty Income Corporation. Case in point, the last time that they decided to grow their dividend was back in December of 2021. So to recap, out of this entire list, I would argue the two regional banks look pretty solid. If I wasn't currently buying up shares of Realty Income Corporation and PepsiCo and a little bit of AMD, then I would probably have some powder to buy one of those two between you and me. But depending on who you ask, they could have Intel that I have as last place as number 1 and Apple Maps as number 2. Said no one ever. Who would ever think of Apple Maps being that high on a ranking list? I'm telling you, Apple Maps is so freaking bad, especially when you compare it to Google Maps. Apple Maps is utterly useless, especially here in Japan. You can't even use it. It's useless like connecting to Wi-Fi with just one signal bar. You can't stream anything beyond the lowest quality rate. It's not even worth it. But I digress. So your ranking of these companies could be very different depending on if you believe in high risk, high reward, or if you are fine with low risk and low returns. But all in all, I think they're all decent. There's nothing too crazy here except maybe number 6. This one, I would argue, is kind of a gamble. And you might think that the video is over, but stick with me, because now I have some words of advice for you. It can't be a Dividend Compounders video if I don't throw some guidance your way. Now look, I've been there before. When I was new to investing in the stock market, I genuinely preferred stocks that were cheaper because it meant that I could accumulate more shares. I thought that if I had more shares of one company in my pocket, it had more value. However, what you must keep in mind is that a cheap stock, especially its price, it doesn't mean that the stock is undervalued. Because on the other side of the argument, it also paints a picture of their total return not being that good, unless they had a stock split. But think about it. If a company trades for about $7 a share, and then like 20 years later, it trades for about $9 a share, that means your return on investment, your ROI, is not the best. Do you get where I'm coming from? And that's why I would argue that it's better to just invest into fractional shares of a very pricey company that is high quality. What I'm trying to say is, if you expand beyond companies that trade for around $20 a share, then your options get better, tastier, and sweeter. I'm talking about a company that trades for about $450 a share, could be more undervalued than almost every other company that we talked about here on this list today. For example, Adobe. Last week, I was buying up shares of Adobe because at $440 a share, Absolutely a bargain deal. And I know I might sound like a broken record at this point, but I say all of this because think of buying a stock as buying into and becoming an owner of that business. Honestly, it fundamentally changes the way that you look at stocks. Because instead of playing the guessing game, is it going to go up? Is it going to go down? Or buying into stocks with shaky finances, you will become more picky, more selective, a more long-term perspective and vision in understanding the business's landscape and outlook. If you just consider stocks for the short term and day trading, then of course, all of this goes right out the window. But as a guy who is gathering up compounders in his portfolio, I care about the fundamentals, the finances, the data, and the intangibles. And that's what I'm trying to relay to you today. After I adopted this type of mindset, if the stock price for one of my holdings go down in a particular week, I don't freak out. I used to when I was new to the stock market, but for the most part, I don't. And that's because when I invest as a business owner and with that mindset, I understand the company's potential, despite if the market is acting up like a hormonal woman who is pregnant. Investing as an owner of shares instead of as a stock trader takes the emotions out of the picture and out of the equation. Removing emotions from investing helps maintain discipline, avoid impulsive decisions, FOMO, and focus on long-term goals rather than short-term market noise. I know when there's panic in the streets and everyone is selling, you feel like that's the time to run away from the stock market. But as a value investor who researches companies day in and day out, if I know a high quality company is going on a sell-off for no good reason, that's when I see an opportunity to buy it at a 52-week low. Does that make sense? I'm not standing out here trying to pick up cigar butt plays and companies that are ugly but are also in their 52-week low. But rather, I'm picking up high quality companies that are undervalued because the market is not pricing them correctly, such as Adobe, AMD, and Realty Income Corporation. And the reason why I keep talking about removing emotions when it comes to investing is that way you don't fall in love with ugly companies, and on the other hand, hate beautiful businesses. For instance, I invest into Altria. Yes, the tobacco company. Even though I have never smoked in my life and I hate what their products do to people, the business fundamentals, finances, their economic moat, everything about that company is such a good business operation. My emotions and personal feelings, I hate that company. I really do. But when I look at it objectively and on paper, amazing. But I hear you. That's an extreme example. The reason why you want to take emotions out is so that you can be more stoic if the price goes down temporarily in the day-to-day or the week-to-week. We're talking about a high-quality company, not a cigar butt or an ugly or a disgusting company. If you truly invest into compounders, then over the grand scheme of time, they're going to grow and compound your money. Hence the title Compounders. So there's nothing to worry about. Quite literally. And speaking of nothing to worry about, I watched Lion King for the first time 3 weeks ago as a 30-something-year-old. And in the movie, they talk about Hakuna Matata. And I think that's practical advice for people investing into stocks. The more you panic and do FOMO decisions, the worse off you'll be, or just have more regrets. I'm talking too much, I'm rambling. With that, I'm gonna go. I love you guys. Thank you for clicking like and leaving comments. I read all of them and I appreciate you so much. You have no idea. Anyways, I hope you have a great Christmas. Stay safe. Seriously, stay safe. And I'll talk to you really soon. All right? Peace.